Okay, let's dive straight into a financial event that's really sent ripples through the market and holds some critical lessons for all of us. We're talking about the TruCap Finance Limited Bond default. And this isn't just about one company's problems. It's more a deep dive into how these interconnected vulnerabilities can, well, cascade into a bigger financial shakeup and, importantly, what that means for you and your investment decisions.
Exactly.
So our mission today is really to unpack the sequence of events, understand the deeper issues, and then connect it all back for you as an investor.
Precisely. And what's really fascinating here is just how fast a company's financial health can actually deteriorate and how, a series of events that might seem independent can suddenly converge and create this kind of perfect storm.
Yeah.
So we'll walk you through the key milestones, the timeline, and then explore those underlying factors and the broader implications.
Great. Let's set the stage then. Going back a bit to June 2021, TruCap Finance, it's an RBI-registered NBFC, a non-banking financial company. They issued an NCD, a non-convertible debenture.
Right. And being an NBFC is quite relevant here. They operate a bit differently than banks, often have different funding routes, which can make them, maybe more susceptible to these kinds of liquidity shocks sometimes.
Good point. So this NCD is a 40 crore rupee issue, set to mature way out in January 2027. But right from the start, it got a CARE BB Plus rating, which meant basically moderate risk of default.
And that's the crucial takeaway right there, that BB Plus rating. It wasn't just some letters, it was like a flashing yellow light from day one.
Yeah.
Because for an investor looking at maybe a higher yield, it's so easy to just gloss over moderate risk and see the attractive number. But it tells you straight up, this isn't a guaranteed return. It's conditional. It's tied directly to that company's health. Demands a whole different level of scrutiny, really.
Okay, so that baseline risk was established early. Now let's jump forward quite a bit to June 3rd, 2025. So just over a month before the actual default. A report comes out from Infomerics, and it highlights a really significant deterioration in TruCap's asset quality.
Right.
Their gross non-performing assets, GNPAs, basically loans not getting paid back, they jumped from just over 1%, 1.33% in FY24 to almost 4%, 3.69% in FY25.
Wow, that's a big jump.
Huge jump. Signals serious trouble in their loan book, right? And the company also reported a hefty loss, around 67 crore rupees for FY25. Big contrast to the previous year when they'd actually made a profit of about 12 crore.
Okay, but here's the thing that really puzzles me about that June 3rd report. Despite those really alarming numbers, plunging asset quality, huge losses, that very same report stated the company's liquidity adequate as of March 31st, 2025.
Yeah.
How do you square that? It feels like maybe a bit of a disconnect or a blind spot.
It certainly looks that way in hindsight. It's almost like that adequate liquidity was a snapshot that just completely missed the storm clouds gathering. Because the very next day, June 4th, 2025, CARE Ratings hits them with another blow. They downgraded TruCap Finance's NCDs, took them down from CARE BBB to CARE BB Plus, and importantly, with Rating Watch, with developing implications.
Yes, and that specific downgrade, that was the real trigger, a pivotal moment. Why? Because it activated something called an acceleration of payment clause. It was right there in the debenture trust deed.
Okay, explain that clause a bit more.
Sure. It's a really powerful tool in bond agreements. Think of it like a pre-agreed emergency brake for the investors. If the company's financial health drops below a certain point, like this credit rating downgrade, the investors can pull that brake. They can demand their money back immediately. Principal, interest, everything.
Wow.
Regardless of the bond's original maturity date. So it basically transforms what was long-term debt into an instant, potentially crippling short-term liability.
Okay, so that downgrade flips a switch, and then the dominoes really start to fall faster. June 10th, 2025. Catalyst trusteeship, they're the debenture trustee.
Right. They represent the bondholder's interests, kind of the referee.
Exactly. They formally notify TruCap about this acceleration clause being activated. Then, just 4 days later, June 14th, TruCap, now facing these immediate demands for repayment, asks the trustee to try and get a waiver from the bondholders.
Yeah, basically saying, can you ask them to hold off? It was a bit of a desperate plea, sounds like, sent via email. And adding to all that pressure, there was this expectation. On June 15th, they were supposed to receive 50 crore rupees. It was the first part of a bigger 100 crore commitment from the Marwadi Chandarana Group.
So incoming cash was expected right around then.
Vital incoming cash. And the fact that these funds didn't arrive, that non-receipt, that proved to be a huge factor in the liquidity crisis that followed. It really underlines the risk, for companies and investors when you're banking on future unconfirmed money coming in.
Absolutely. Then, a few days later, June 20th, another maybe more subtle sign, the CFO, Mr. Sanjay Kukreja, resigned. Now, that's not a direct cause of the default, obviously, but high-level departures, especially the CFO, it can often be like that canary in the coal mine, right? A signal for investors that maybe things aren't looking so good internally.
Exactly. It raises questions about confidence, about what's really happening behind the scenes. So then, by June 25th, the debenture holders, they formally exercise their option. They demand that accelerated repayment of principal and interest.
So they didn't grant the waiver.
Nope. This action was a direct consequence of that rating downgrade and the acceleration clause being triggered, and it created this double whammy effect, you could call it. The company's internal weaknesses, like the bad loans, were getting worse.
Right.
Plus, the external funding they hoped for didn't arrive. And then, boom, these contractual triggers create this immediate, massive demand for cash they just don't have.
An unmanageable demand. And the inevitable conclusion arrives on July 16th, 2025. TruCap Finance officially fails to make the scheduled interest and principal payments on its NCDs, about 72 crore rupees. That's the default.
That's the moment of default. And right after that, on July 18th, Care Ratings hammers the final nail in, downgrading everything bank facilities, NCDs to Care D for default. Infomerics also confirmed the default, downgraded their ratings too. And TruCap then publicly disclosed, yes, we can't make the payments.
Right. And the final steps in this sequence unfold quickly then. July 19th, Infomerics withdraws the rating for any proposed NCDs.
Yeah, because TruCap confirmed they weren't going ahead with issuing any more debt, understandably.
Understandably. And then, August 11th, the debenture trustee calls a meeting of the bondholders, basically to figure out, okay, what do we do now? How do we try and recover something by enforcing the security?
Yeah, starting the recovery process.
It's a really stark timeline, isn't it? Looking back, it just feels like this financial house of cards just collapsing step by step. We've walked through the sequence, but let's dig a bit deeper. What were the foundational weaknesses? What really led to this? Where did the cracks, truly begin?
Yeah, you're right. It wasn't just one thing, one domino. It was, like we said, a convergence. Several deeply interconnected financial and operational issues created that perfect storm. First, and maybe most critically, a severe liquidity squeeze. We touched on it, but the numbers are stark. As of May 31st, 2025, remember, they needed about 103 crore rupees for debt repayments in the next 3 months.
Okay.
But they only had about 57 crore in cash that wasn't already tied up. That's a massive gap, a critical deficit that basically made their situation unsustainable right there.
So the cash crunch was already baked in, almost.
Absolutely. It was brewing significantly. Second, the non-receipt of those committed funds, that 50 crore from the Marwadi Chandarana Group, it wasn't just nice to have, it was absolutely vital to their plan. Its failure to materialize was a direct trigger, pushing them over the edge into that unmanageable liquidity stream.
Okay. And the third factor?
Third, the premature redemption of the NCDs themselves. That rating downgrade, activating those put options or acceleration clauses, that was a huge blow. It forced them to try and repay debt much earlier than planned, which just further drained their already dwindling cash reserve.
Right. So it's like they were trying to bail out a sinking boat with a leaking bucket, and then the bucket itself started demanding its water back.
That's a pretty good analogy, actually. Exactly. Fourth, that deteriorating asset quality. It was bleeding them dry. Remember, they're an NBFC lending mostly to MSMEs, micro, small, and medium enterprises, and lower income groups. When those GNPAs surged, it meant less cash was flowing back in from loan repayments.
Which they needed to pay their own debts.
Precisely. It starved them of the very cash inflows needed to service their own obligations. Fifth, profitability was just under immense pressure. That huge net loss, roughly 67 crore in FY25, driven by impairment charges, provisions for bad loans, it just significantly eroded their financial health.
And you mentioned they were spending on things like a tech platform.
Yeah, and that's tricky. Committing capital to long-term initiatives, like technology, is often necessary. But doing it when you're facing such acute operational distress, such a short-term cash flow crisis, it can really exacerbate the immediate problem.
So it sounds like maybe they were trying to I don't know, innovate or grow while the core business engine was sputtering badly.
It seems that way. And finally, let's not forget intense competition. TruCap wasn't operating in a vacuum. It's a highly fragmented lending industry. Facing stiff competition likely constrained their ability to grow profitably, to maintain margins. So all these factors, the squeeze, the failed funding, the early repayments, the bad loans, the losses, the competition, they didn't act in isolation. They fed into each other, creating that downward spiral.
Okay, so that paints a clearer picture of the why. Now, this whole TruCap deep dive, it isn't just a sad story about one company. It really serves as a guide, I think, for all of us to maybe reevaluate how we assess investment safety. And it certainly highlights the difference between investing directly in a bond like this versus other paths like, say, mutual funds. Let's unpack that a bit.
Yes, absolutely. Connecting this back to you, the investor, it's so critical to understand the differences across these key dimensions. First, let's talk risk profile. Bonds, like TruCap's NCDs, carry that direct risk of the issuer defaulting. If the company fails, your investment is directly, significantly at risk.
Right. Your fate is tied to that one company.
Exactly. Mutual funds, on the other hand, work by pooling money from many investors and diversifying it across lots of different investments, maybe stocks, maybe other bonds, maybe both. This diversification helps spread the risk. Now, they're still subject to market ups and downs, market volatility, but the failure of one single company won't typically wipe out your investment. Plus, there's professional management actively trying to mitigate those risks.
Okay, risk is one thing. What about the returns? Because those TruCap bonds, they're offering pretty attractive fixed rates, right?
They were, and that's the allure. That's the second point. Returns. Bonds like TruCap's were marketed with fixed returns, 13.5% in this case. Sounds great. But as we've just seen in painful detail, that return depends entirely on the issuer's ability to actually pay you back. That promise of a guaranteed return, it's always conditional on the company staying healthy.
Got it.
Mutual funds, conversely, offer market-linked returns. They don't promise a fixed income. Their value goes up and down with the market. But historically, many have delivered competitive long-term growth. And importantly, they're transparent about this market-linked nature, about the risks involved. It allows for a more realistic expectation.
Okay, so risk and return differ. What about getting your money out when you need it? Liquidity.
Huge difference there. That's point 3. Liquidity. Corporate bonds, especially ones that are lower rated or, heaven forbid, post-default like TruCap's, can become highly illiquid. It can be incredibly difficult, sometimes impossible, to sell your position quickly without taking a massive loss, if you can sell it at all.
So you could be stuck.
You could be stuck. Mutual funds, in stark contrast, generally offer daily liquidity. You can usually buy or sell units on any business day at the prevailing net asset value, the NAV. Much easier access to your cash.
Right. And you mentioned diversification earlier.
Yes. Fourth point.
Yeah.
Diversification. Crucial. When you invest in one single bond, like the TruCap NCD, all your eggs are in that one basket. If that company fails, your investment takes a massive hit. Mutual funds, by their very nature, mitigate this. They invest across maybe dozens, even hundreds of different securities, different companies, different sectors. It significantly reduces the impact if any single one fails.
Okay. And the final point you touched on was management.
Yes. Fifth. Management and oversight. This is key. With direct bonds, you, the investor, are largely on your own. You need to do the research, monitor the company's health, react to news like rating changes.
Which takes time and expertise most people don't have.
Exactly. Mutual funds, however, are professionally managed. You have SEBI-registered fund managers and teams of analysts behind them. SEBI, of course, being the Securities and Exchange Board of India, our main market regulator, setting rules to protect investors. These professionals are constantly tracking markets, analyzing companies, managing risk. Now, they can't eliminate risk entirely. Nobody can. But that active professional oversight provides a really strong layer of defense that an individual bond investor typically lacks.
That makes sense. You know, the TruCap incident, it really hammers home that no investment is truly risk-free. Not stocks, not bonds, not funds. But the crucial thing, it seems, is how well those risks are understood, how they're managed, and importantly, how they're diversified.
Precisely.
And we've seen this sharp rise recently in bond promotions, haven't we? Often using very appealing words like guaranteed or secure to draw investors in with these seemingly high fixed returns.
Yes, and that narrative, as the TruCap case perfectly illustrates, can be incredibly misleading. That guarantee is only as good as the guarantor. Mutual funds, while not guaranteeing returns, are generally much more upfront about their risks in their offer documents. This transparency helps you make informed, realistic decisions based on your actual risk tolerance, not just based on an alluring headline rate.
So wrapping this up, the TruCap default really is a sobering lesson, especially for anyone tempted by that illusion of high guaranteed returns from individual bonds.
Yeah.
It just strongly underscores the need for thorough due diligence, really understanding what you're buying, understanding the true nature of credit risk, and the absolute necessity of diversification in your investment strategy. For most retail investors, probably the more resilient path forward involves a balanced approach, asset allocation across different things, a clear understanding of the instruments you choose, and a long-term perspective. And mutual funds, when you choose them carefully and keep an eye on them, they do offer that professional oversight and diversification that can really help manage risk more effectively than going it alone in single bonds, especially lower-rated ones.
Absolutely. Think of this deep dive not as something to induce fear, but really as a guide towards greater awareness, towards building more resilience into your financial journey. Remember, while no investment is ever fail-proof, things like transparency, diversification, and professional management can definitely help position you to better withstand these kinds of financial shocks when they happen.
Well said. And just before we close, a crucial reminder for everyone listening, we are not SEBI-registered financial advisors.
That's right.
This discussion is for informational purposes only. If you are considering making any investment decisions, please consult a certified financial advisor who understands your specific situation and goals.